Hey folks, Jordan with my strategic forecasts Inside the Numbers Live. And I wanted to do a special video for you all on one of my favorite subjects, the VIX Fear Index. Now, a lot of folks have heard about it, but they don't understand the nuances of it, and there's some really interesting features of it that can help us in our trading. So, what most people know is that the volatility index, also known as the VIX, is a gauge of fear in the market. What it actually measures is options demand on the S&P 500, both calls and puts. Now, very few of us will actually ever buy options directly on the S&P 500. Typically, that's done by large institutions and hedge funds. Now, when they do it, they typically do it as a hedge, and what they'll do more often than not is buy a put or a bet that the market is going to head lower. Now, why would they do that? Well, if you think about it, these big funds have baskets of stocks that they own. So they'll own, say, Apple, Amazon, Facebook, Google, Goldman Sachs, and a whole bunch of other companies. They believe that those stocks are going to outperform the broader market. But at the same time, they need to protect themselves against market crashes. So what they'll do is they'll go out and rather than try and buy protection on the individual stocks themselves, buy it on a broad basket such as the S&P 500. So that's why when you see the VIX, you are actually looking at options demand for the S&P 500. And this is typically measured going out 30 days. Now, most of us also know that there is an inverse relationship between the S&P 500 and the VIX. People, they get scared. And when they get scared, they start to buy protection. That typically happens on the S&P 500 as the market's going down. So what you'll see here is that in this chart on the right side, the S&P 500 is going up, and on the left side you'll see the VIX, the VIX index is going down. In fact, if you look at this low here on 617, it coincides with one of the highs up here on the VIX. But what you'll notice here is 617, the high here is slightly below the two higher highs before that, and yet the S&P 500 is making a lower low. That's a key divergence that you can use to find possible bottoms before they actually happen. And it's a great way to use the VIX and SPY relationship to look for divergences, because typically they have a very tight correlation. Now, I want to take this even further and show you how I even use this to trade the ES futures or the SPXL on an intraday basis. Now, what you'll notice here is a bunch of lines on the VIX. These are lines that I actually develop and I share only with Inside the Numbers Live members. They're levels that I teach on how to come up with them, and it's a little bit different than the methodology that David uses. And these levels are fairly easy once you understand the methodology to come up with them, and they work as great support and resistance for the VIX. Now, if you think about it, if the VIX is coming into a support level, that should mean that the S&P 500 is coming into a resistance level, right? Conversely, if the S&P 500 is coming into a support level, the VIX should be coming into a resistance level. And when you have the two of them line up where you get to a key level on the S&P 500 and a key level on the VIX, that's when you get what is part of a full stack trade using some additional information that I provide. So let me show you what that looks like a little bit on an intraday basis. So here's a great example where I've dug into the 5-minute chart of both the VIX and the SPY. Now, what you'll see here is that at the start of the day, the VIX climbed from the 23.88 level all the way up right into the $24.58 level. And from there, it smacked right into it and fell away. At the same time, we had the SPY come down into one of the levels that David prescribed in the Inside the Numbers, smack right into the $407, and then push right away from this. When I see the two of these come together at the same time, it gives me extra confidence that we're going to see a reaction in the opposite direction, because I know that if this level here is going to act as resistance and force the VIX to head lower, that is going to put upward pressure on the SPY. And if at the same time the SPY is about to hit a support level, that's going to give it an additional boost that should push it higher. And that's how I can put the two together to create an augmented trade that gives me even more confidence in what can happen. This is just a snippet of some of the additional education that I like to bring to the table for exclusively Inside the Numbers Live members. It helps to add on to what we already know from what David teaches us and become even better traders. Now, we have a 7-day free trial for anybody that's interested. You can see how the whole thing comes together, and it's a perfect opportunity to see somebody trade live, be able to have questions answered that you otherwise might not be able to. My name is Jordan with My Strategic Forecast Inside the Numbers Live. Thanks for tuning in.